25 to 35% down to the 80 to 90 range. Make absolutely sure you can survive that psychologically and financially without panic selling. Make sure you have cash ready to buy it when we hands capitulate. Don't let the recent recovery fool you into over-leveraging now. To the aggressive bulls, you bought the 102 dip. Maybe you're using leverage right now. You're convinced 150 to 200 is coming, and you want maximum possible exposure to capture it. You might be completely right about the destination, but please deleverage before the next shakeout hits. The January 27th crash proved beyond any doubt that leverage kills even correct positions. Own physical metal, raise cash, give yourself the ability to survive a test of 85 to 90 without liquidation. Being right about the direction doesn't matter if you're gone before the move actually happens. The silver market just did exactly what I've been warning about for months. 2 violent shakeouts within a continuing bull market. January 8th crashed to 76. January 27th crashed to 102. Leveraged bulls destroyed, despite being directionally correct about $100 plus silver, and it's not over, not even close. The final massive shakeout, the 25 to 35% one that takes silver from whatever new high it makes down to $80 to $90, is still coming. It will probably be the final washout before the real parabolic move to 150 to 200 plus. The bulls who understand this will be prepared. They'll hold physical metal through the insane volatility. They'll buy the panic with cash reserves they kept ready. They'll be properly positioned when silver breaks out for real and never looks back. The bulls who don't understand this will be shaken out. They'll sell at 85 to 90 in absolute terror. They'll watch helplessly from the sidelines as silver does exactly what they predicted without them in the trade. The path to 150 to 200 goes through 80 to 90 first. The path to generational wealth goes through gut-wrenching drawdowns that test your conviction. The path to being proven right goes through periods of feeling completely, utterly wrong. Don't be the person who was right about silver and still lost money because you couldn't survive the journey to get there. You now have the information, you have the proof from what just happened in January. You have the warning about what's coming next. What you do with all of this is entirely up to you. Make the right choice. The silver bulls think they've got it all figured out. They watched it rocket from $30 to $117 in just 12 months. They white-knuckled their way through 2 flash crashes in 3 weeks. They think they've seen it all, that they're battle-tested and ready for 150, 200, maybe even higher. But here's the truth. They're not ready to hear. They have no idea what's actually coming. What's about to unfold in the silver market is going to catch everyone off guard. The bears who are convinced the bull market died at 117. The skeptics who've written off precious metals entirely. And yes, even the bulls who bought every single dip thinking the worst is finally behind them. They're all in for a shock. I'm going to show you data that even the most hardcore silver investors are completely misreading. We're looking at a convergence of factors that has never happened before in market history. Not during the madness of 1980, not in the chaos of 2011, not even in the absolutely wild January 2026 we just lived through. By the time we're done here, you'll understand why even the people who correctly called silver hitting 100 plus are dramatically, almost dangerously underestimating what comes next. And it's coming fast. Welcome to the hidden economy, where I break down the financial moves that mainstream media either ignores or completely misunderstands the setup. Before we go any further, I need to be crystal clear about something. This isn't a bearish take on silver, not even close. I think silver is headed significantly higher over the next 12 to 24 months. I believe the fundamentals are stronger than they've ever been in history. We could absolutely see 150, 175, maybe even 200 plus if the physical market actually breaks the way some analysts think it will. But this also isn't your typical bullish silver content that you've heard 100 times before. This is about understanding a market dynamic that just proved itself in January 2026 twice and is about to prove itself again, even more violently. The bulls are absolutely right about the destination, but they're completely catastrophically wrong about the journey. And that journey is going to shake out more investors than anyone expects before the real parabolic move begins. Let me walk you through what just happened, what it actually means, and what's coming next. January's brutal lessons. Before I tell you what's coming, you need to understand what already happened. Because if you don't get what went down in January 2026, you won't survive what's next. January 8th, 2026. That was the first warning shot. Silver had been on an absolute tear, rallying from around $70 in late December to $84 by early January. The momentum was building. The bulls were confident, maybe even a little cocky. Then the CME group dropped an absolute bomb on the market. They announced a 47% increase in maintenance margins for silver futures overnight. No warning. Maintenance margins jumped from $22,000 to $32,500 per contract. Think about what that means. If you were holding 10 contracts with minimal excess margin, you suddenly needed an additional $15,000 in cash, posted immediately. Not tomorrow, not next week. Immediately, or your broker would liquidate your positions automatically, whether you liked it or not. The result was predictable and brutal. Silver crashed from $84 down to the 75 to 76 range. A 10% drop in a single session. Leverage longs got absolutely wiped out. Stop losses triggered like dominoes. Margin calls went unanswered because people were asleep or at work. Forced liquidation cascaded through the market like an avalanche. The bulls dusted themselves off and said, "Okay, that was the correction we needed. The weak hands are gone now. Time to rally for real." They were half right. Silver did rally. But they were completely wrong about the weak hands being gone. Dead wrong. Fast forward to January 26th and 27th. After that January 8th crash, silver didn't just recover. It went absolutely parabolic from $76 to $94 by mid-January. Then it went completely vertical like a rocket ship. It cleared 100, then 105, then 110, then 115. On January 26th, during U.S. trading hours, silver hit an all-time record high of $117.54. The bulls were euphoric. Everyone who had missed the rally from $30 finally capitulated and bought in at the top. FOMO was at absolute maximum levels. Retail participation was at extremes, the top was in, and nobody saw it coming. Then at 11 p.m. Eastern Time, during the absolute thinnest liquidity window of the entire 24-hour trading cycle, massive coordinated selling slammed into the market. This wasn't normal profit-taking. This wasn't gradual selling. This was a concentrated blast of sell orders designed to overwhelm every single bid in the order book. According to Action Forex, silver tumbled 13% in just 4 hours from the 11/17/54 peak, down to an intraday low of $1,252 during the Tuesday, January 27th Asian session. $15, 4 hours, a 13% crash from the all-time high. Leverage traders who had somehow survived January 8th were completely annihilated. Stop losses triggered at 2 in the morning while Americans were sleeping. Margin calls that physically couldn't be met. Forced liquidations that added even more selling pressure to an already collapsing market. The cascade fed on itself until buyers finally mercifully stepped in around 102. By Tuesday afternoon, silver had bounced back to 11,272, but the damage was done. Bulls, who were euphoric at 117, were now traumatized. Some sold in panic, some held on for dear life. But all of them learned a painful lesson. Being right about direction doesn't save you from being completely destroyed by volatility. Here's the part that most people are missing right now. This pattern isn't over. It's not even close to being over. It's just beginning. The dangerous consensus. Let me summarize what the silver bulls believe right now, because I actually agree with almost all of it. The fundamentals are genuinely strong. Industrial demand is absolutely exploding. Solar panels, electric vehicles, artificial intelligence, data centers, 5G networks, they all require massive amounts of silver. According to research from Golds, industrial demand now exceeds 700 million ounces annually and is structurally growing because of government mandates around green energy. And here's the kicker. There's no substitute for silver's unique conductivity properties. Supply is seriously constrained. Approximately 75% of silver comes as a byproduct of mining copper, zinc, and lead. You can't just open new silver mines when prices rise. The supply is essentially fixed in the short term, no matter how high prices go. The market is running a massive deficit. 2026 marks the 6th consecutive year of supply deficits, according to Metals Focus and ING. Demand exceeds supply by roughly 200 million ounces every single year. That gap gets filled by depleting COMEX warehouse inventories and other stored supplies. Speaking of COMEX inventory, it's collapsing. Total inventory sits around 445 million ounces, but only 124 million is classified as registered and actually available for delivery. In mid-January, 33.45 million ounces were withdrawn in just 7 days. That's 26% of registered inventory gone in a single week. Think about that. The gold to silver ratio supports massive upside. With gold at $4,500 to $4,600, the ratio sits around 40 to 1. The historical mean is 15 to 1. Even at a conservative 30.1 ratio, silver should be trading at $150. At 21, silver would be 225 to 230. The math is compelling. And here's the real kicker. Smart money is accumulating like crazy. JP Morgan issued 99% of 8.1 million ounces delivered on January 7th, 2026. They've completely reversed from being massive shorts to taking maximum physical delivery. Central banks are accumulating. The traditional market suppressors have essentially capitulated. All of this is true. All of this points to silver going significantly higher over time. The bulls are right about the fundamentals. They're right about the destination. So what are they missing? The fatal blind spot. Here's what almost nobody is talking about in the aftermath of January's crashes, and it's absolutely critical. Being right about direction doesn't mean you'll survive the journey to get there. Think about this carefully. The bulls who bought silver at $80 after the January 8th crash were absolutely 100% right. Silver went to 1117.54. That's a 46% gain on 15 to 1 leverage, which is the current margin requirement. That's a 690% return on capital. They were euphoric, they were vindicated, they were right. Then the January 27th crash hit at 2 in the morning from 117 down to 102 in 4 hours. By the time they woke up and checked their phones, they were liquidated, margin called, stopped out, game over, account blown up. They were directionally correct about the bull market, but got completely, utterly destroyed because they couldn't survive the volatility. Their corpses are now the exit liquidity for institutions. Here's what the current bulls are missing. The ones who bought the dip at 105 to 110 and think the coast is finally clear. The final massive shakeout hasn't happened yet, not even close. Look at the pattern from every major silver bull market in history. In 1980, silver ran from $6 to $50. There were multiple corrections of 25% or more along the way. The final blow-off top at $50 was followed by a crash down to 10 within weeks. The Hunt brothers were forced to sell. Leverage bulls were destroyed. In 2011, silver ran from $18 to $49. There were multiple gut-wrenching drops of 15 to 30% within the bull market. The CME raised margins 5 times in 9 days near the top. Silver crashed from 49 down to under 30. Leveraged bulls were destroyed. In 2026 so far, silver has run from $30 to $11.54 worse. We've had 2 violent corrections, 10% and 13%, but we haven't had the final 25 to 40% washout yet. The one that convinces everyone the bull market is completely over right before it goes truly parabolic. That's what's coming, and most bulls aren't even remotely prepared for it. The leverage time bomb. Let me tell you about the danger that's still present in this market. Even after 2 flash crashes wiped out thousands of traders in 3 weeks. After January 27th, some leveraged players were completely destroyed, but many survived because they had stops above 100 or weren't fully margined when silver peaked at 115 to 117. These survivors now think they're smarter. They think they learned their lesson about volatility. They've adjusted their stops down to 95 or 90. They think they're managing risk properly now. But here's what they fundamentally don't understand. At 15 to 1 leverage, which is the current requirement after CME's 47% margin hike, a 7% adverse move still wipes out 100% of your capital. Silver just proved it can move 13% in 4 hours. That happened on January 27th. It proved it can move 10% in a single session. That happened on January 8th. Yet, retail participation in leveraged silver remains stubbornly high. Reddit communities are filled with people talking about buying the dip with futures. YouTube comments are full of traders saying, I added more contracts at 108. This overconfidence is the fuel for the next cascade. When the next shakeout comes, and I promise you it will come, these leverage longs will be liquidated en masse. Their forced selling will amplify the downward move. Stops will trigger more stops in a vicious cycle. Margin calls at 2 in the morning will go unanswered because people are asleep. The death spiral will repeat itself, only bigger this time. Here's the pattern that's going to repeat, and you need to burn this into your brain. Silver makes a new high above 1117.54, maybe 125 or 130. Euphoria returns. Everyone's screaming, we were right, 150 is next. Leverage positions build up at these highs as FOMO kicks in. Then a catalyst triggers selling. Could be another margin hike, could be profit taking, could be a coordinated attack during thin liquidity. The initial drop triggers the first wave of stop losses. Those stops trigger margin calls during the Asian session. It's 2 to 4 a.m. Eastern Time when Americans can't respond even if they want to. Forced liquidations add massive selling pressure to an already falling market. Algorithms detect the downward momentum and pile on with even more selling. And you get a 25 to 35% crash over several days before buyers finally step in to stabilize things. We've seen 10%, we've seen 13%. The next one could easily be 25 to 35%. That would take silver from 120 down to the $78 to $90 range. Violent enough to convince absolutely everyone that the bull market is dead and over. And that's exactly when the real move begins, the margin hike weapon. Let's talk about the weapon that's already been deployed once and will absolutely guaranteed be deployed again. CME margin requirement increases. We just witnessed this on January 8th, 2026. The CME raised margins 47% overnight with zero warning. The result, a 10% crash and forced liquidation of thousands of positions. Money managers woke up to find their accounts blown up. But here's what bulls desperately need to understand. They'll do it again. They always do. History proves it without exception. Look at the historical pattern. In 1980, exchanges raised margins and actually restricted buying as silver approached $50. Silver crashed from 50 all the way down to 10. Bulls were destroyed. In 2011, the CME raised margins 5 times in 9 days as silver ran toward $50 again. Silver crashed from 49 down to under 30. Bulls were destroyed. In 2026, the CME raised margins 47% on January 8th when silver was at 84. Silver crashed to 76. The pattern is undeniable and crystal clear. Every single time silver gets too hot, the exchanges intervene with margin hikes to supposedly manage volatility and protect market integrity. It's the same playbook every time. Right now, silver is trading at 110 to 112 after hitting 11.54. Many bulls are thinking the margin hike already happened on January 8th. CME won't do it again so soon. We're safe now. That's dangerous. Wishful thinking, that's going to cost people fortunes. If silver makes a sustained move above 125, or especially above 135 to 140, the CME will face enormous pressure from short sellers, regulators, and their own risk managers to raise margins again. They'll have no choice. Another 30 to 50% hike could take requirements from a 32,500 up to 42,000 to 48,000 per contract. That would force immediate liquidations from traders who are currently safely margined and think they're fine. The playbook is established. The historical precedent is clear. The weapon will be used again. Plan accordingly or get destroyed. The paper versus physical wildcard. Now, let me introduce the variable that makes this setup either catastrophically bearish in the short term or explosively bullish, depending on exactly how it resolves. The paper physical divergence dynamic. During the January crashes, something absolutely revealing happened that most people missed. Paper prices crashed hard, but physical demand stayed incredibly strong. Physical premiums held at 20 to 35% over spot prices in Western markets. Dealers reported surge buying at 102 to 105 during the crash. In some markets, physical silver was completely unavailable despite paper prices showing bargain prices. Even more extreme, and this is absolutely wild, on January 1st, 2026, when China's export controls kicked in, physical silver in Japan and the UAE was selling at $130, while COMEX futures were showing $72, an 80% premium. That's unprecedented in modern precious metals history. Here's what this means for the next shakeout. And there are 2 possible scenarios. Scenario 1 is a normal correction, which is the more likely outcome. Paper crashes 25 to 35%. Physical premiums spike to 30 to 50% temporarily. Both markets move roughly together, more or less. Recovery follows over weeks or months. The bull market continues. Business as usual. Scenario 2 is a system break, which is possible but less likely. Paper crashes 25 to 35%, but physical premiums absolutely explode to 80 to 100% or more. The divergence becomes undeniable to everyone watching. Confidence in the paper market completely shatters. Institutions scramble desperately for physical metal. We get forced repricing as paper must catch up to physical reality. A violent short squeeze follows immediately. Here's why Scenario 2 is actually possible this time. And you need to pay attention to these numbers. Current COMEX registered inventory sits at 124 million ounces. March contract, open interest, represents over 500 million ounces. That's 4.1 leverage minimum. Some analysts estimate total system leverage at 100 to 1 or even 250 to 1. Lease rates are at 8% versus the normal 3 to 5%. That's 16 times elevated, showing desperate demand for physical. We're seeing persistent backwardation, meaning spot is trading above futures. The market is screaming for metal now, not later. China's 2-year export licensing restrictions are still active. And remember, 33.45 million ounces drained in 7 days. That's 26% of registered inventory. If the next crash triggers mass delivery demands, while physical supply is this tight, we could actually see the paper market break, not just diverge from physical, actually break. The system could fail. Nobody knows which scenario happens. But the setup for Scenario 2 is absolutely present in the market right now. What the charts are saying, let me show you what the technical picture is telling us about the next move, because the charts are remarkably clear right now. According to Action Forex technical analysis, as of late January 2026, here are the key levels. Support sits at the ascending trend line from the January 8th low of 73.84, which currently runs at 99.39. Medium-term pivotal support zone spans from 9.224 down to 8.772. And major psychological support is obviously at $100 flat. For resistance, we're looking at the recent all-time high at 11.7054. If that breaks, next targets are 11.1854 to 12.161, then 12.612 to 12.762. Here's the critical observation from Action Forex, and I quote, Despite the latest 13% plunge, silver has continued to trade above a key minor ascending trend line in place since the 8th of January 2026, low of 73.84. What this tells us is crucial. The bull structure is technically still intact as long as silver holds above $99. But the pattern strongly suggests we're in a topping process, not a breakout. We're forming a top, not launching higher. Here's the likely sequence, and you should prepare yourself mentally for this. We get a rally attempt toward 120 to 130, possibly making a marginal new high above a 17.54. Then rejection, failure to sustain above 120, a break below the $100 psychological support level, acceleration lower to test the 92 to 87 support zone. Then final capitulation, washout, panic selling, volatility spike, maximum fear across the market. That's when the real breakout begins after everyone has given up. This would represent a 20 to 30% correction from current levels from 110 down to the 77 to 88 range. Violent enough to convince everyone that the bull market is completely over, scary enough to liquidate all remaining leveraged longs and shake out weak hands. And that's exactly when strong hands buy and weak hands capitulate. What smart money is doing. Here's what you absolutely need to understand about the January crashes. They destroyed retail traders and enriched institutions. The wealth transfer was massive and deliberate. Who got liquidated? Retail traders using leverage, momentum chasers who bought at 115 to 117 at the top. FOMO buyers with tight stops, overleveraged speculators who thought they were smart, who accumulated. JP Morgan issued 99% of 8.1 million ounces delivered on January 7th. Physical buyers who had cash sitting ready. Institutions calmly taking delivery during the crashes. Smart money with zero leverage who couldn't be shaken out. The pattern is crystal clear. Institutions use manufactured volatility to shake out competition and accumulate physical metal at artificially suppressed prices. This happened on January 8th, crashed to 76. They bought heavy. Rallied to 94 plus. This happened on January 27th, crashed to 102. They bought again, bounced to 112 plus. It will happen again. According to commitment of traders data, commercial short positions remain significantly reduced even after these crashes. The traditional market suppressors aren't fighting this bull market anymore. They've switched sides. But they are absolutely using controlled crashes during thin liquidity windows to shake out leveraged retail before the real parabolic move happens. Translation. Smart money knows silver is going to 150 to 200 plus, but they also know they can engineer crashes to buy cheaper and eliminate their competition at the same time. The bulls who survive these shakeouts will profit alongside the institutions. The ones who don't survive become the institution's exit liquidity. Choose which group you want to be in. The timing question. When does the next big shakeout happen? When should you expect it? Honest answer, I don't know. Nobody does. Anyone who tells you they know exactly when is lying to you, but I can tell you what conditions typically precede major shakeouts. And we can watch for these warning signs. Extreme bullish sentiment where everyone is convinced it can only go up. Heavy speculative positioning with leverage longs at extremes. Approaching major resistance levels. The 120 to 130 zone will likely be the trigger. And complacency about downside risk, where bulls only talk about upside targets and ignore the risks. We saw all four of these conditions on January 26th at 11:54. The result, a 13% crash in 4 hours that wiped out thousands of accounts. Right now, we're already seeing a complacency return after the bounce to 110 to 112. Bulls are saying things like, buy every dip and the worst is over. Now, that mindset is genuinely dangerous and will cost people money. The next shakeout could come when silver attempts 125 to 130 and runs into concentrated selling. It could come when CME announces another margin hike, which is likely above 125. It could come when a major hedge fund faces redemptions and has to liquidate positions. It could come when a geopolitical event causes panic liquidation across all asset classes. Or it could happen during any Asian session when liquidity naturally thins out. Could be next week, could be next month, could be 3 months from now. But the conditions are forming. The fuel is building. The trigger will come eventually. Who survives and who doesn't? Let me tell you exactly who won and who lost in January because it reveals who's going to win and lose in the next shakeout. The winners were physical holders with zero leverage. They faced no margin calls. They still own the exact same number of ounces. Traders who had cash reserves ready to buy at 102. Institutions like JP Morgan calmly taking delivery. And people positioned to emotionally and financially survive 40 to 50% drawdowns. The losers were leveraged longs who got liquidated overnight while sleeping. Stop losses that triggered at the absolute worst prices. FOMO buyers who chased the market at 115 to 117. And people who panicked sold at 102 to 107 locked in losses. What in strong hands actually means in practice. You own physical silver in the form of bars or coins that literally cannot be marginal called. You use zero leverage with position size to survive a 40 to 50% potential drawdown without liquidation. You keep cash reserves ready to buy the next shakeout if we hit $80 to $90. You have conviction from research, not from emotion or FOMO. And you're mentally prepared for gut-wrenching volatility that will test your resolve. The bulls who went all in on leverage at 90 to 100, thinking this time is different, got completely destroyed at 102. Their accounts are gone. The bulls who owned physical metal at 90 to 100 still own it at 110. And they'll still own it at 175 plus when this really moves. Be strong hands, not weak hands. The difference is everything. What comes after the washout? Now, let me paint the picture of what happens after the final shakeout. The big one that takes silver from whatever the next high is down 25 to 35% to the $80 to $90 range. The leveraged players are completely gone, totally liquidated, out of the market permanently. They're no longer creating overhead resistance with stops and profit taking because they have no positions left. The weak hands have capitulated. They sold at 85 to 90 in absolute panic. Their physical silver is now in the hands of institutions and strong hands who will not sell at any price in the near term. Short sellers are forced to cover. They profited handsomely on the way down. Now they're trapped if silver reverses hard. Their covering creates massive buying pressure. And here's the key. The fundamentals haven't changed at all. Industrial demand is still 700 million plus ounces and growing because of solar, electric vehicles, and AI mandates. Supply deficit is still the 6th consecutive year with a 200 million ounce shortfall annually. COMEX drain continues. The 124 million registered inventory still can't satisfy 500 million plus in open interest. China's controls are still in effect with 2-year licensing restrictions active. Lease rates are still at 8% versus 0.3% normal, screaming desperate physical demand. And gold is still at 4,500 plus, supporting the entire precious metals complex. With the market completely cleansed of speculation and weak hands, the real parabolic move begins. And this rally surprises absolutely everyone. It surprises the bears, who thought the crash meant it was over. Wrong. It was just the reset button. It surprises the bulls, who dramatically underestimated the magnitude. When resistance finally breaks with no overhead supply, we get true price discovery to 150 to 200 plus. And it surprises the general public who wasn't paying attention. They wake up one day to see silver at 175 and buy the top, starting the cycle over again. Analyst targets after the washout are compelling. Gold Silver's Alan Hibbert projects 175 plus by year-end 2026. Trading keys. Bullish scenario anticipates a spike toward 150 accounting for COMEX stress. And if the paper market actually breaks in scenario 2, we could see 200 plus as physical and paper prices violently reprick reality. The question isn't whether this move is coming. The question is whether you survive the shakeout to participate in it. My personal approach. Let me tell you exactly how I'm positioned after watching 2 flash crashes in 3 weeks destroy thousands of traders who thought they knew what they were doing. I own physical silver bars and coins in my personal possession. They survived January 8th and January 27th completely untouched. No margin calls, no forced liquidation. Same exact number of ounces before, during, and after both crashes. I keep substantial cash reserves. I bought some silver at 102 on January 27th. I'll buy significantly more if we get the big shakeout down to 85 to 90. I want to be a buyer when leverage longs are forced sellers. That's when the best prices appear. I have zero leverage in silver. None. After watching people get absolutely destroyed twice in 3 weeks, people who were directionally correct about the bull market. The lesson is undeniable. Leverage kills even correct positions. Being right doesn't matter if you're dead. I focus on fundamentals, not price. Silver at 117 had identical fundamentals to silver at 102 just 4 hours later. The supply deficit didn't change. Industrial demand didn't change. COMEX drainage didn't change. Only the price changed because of forced selling and manipulation. I'm mentally prepared for the big one. If silver tests $85 to $90, which represents a 25 to 30% drawdown from current levels, my position will show significant paper losses. I've made complete peace with that. I understand it's required to clean out weak hands before the real move happens. This approach won't maximize returns. Someone who perfectly times every top and bottom will make more money than me, but I can't time things perfectly. Nobody can consistently. So instead, I focus on 3 things. Surviving the shakeouts without getting liquidated. Buying aggressively during the panic when others are selling, and holding through the eventual parabolic move that makes it all worthwhile. Final message. Let me speak directly to 3 different groups watching this right now, to the bears. You saw the 13% crash and felt completely vindicated. You might see a 30% crash soon and feel even more right about your bearish thesis. But don't mistake violent corrections for trend reversals. The fundamentals, industrial demand, supply deficits, conch drainage haven't changed one bit. Silver crashed from 117 to 102 and bounced back to 112 within hours. The bull market isn't over. It's just incredibly volatile. Eventually, the mathematics of supply and demand catches up with price. Don't be right. Short-term, but catastrophically wrong long-term. To the moderate bulls, you own some physical silver. You expect higher prices over time. You survived January's chaos. Good. That's smart positioning. But don't get complacent just because we bounced to 110 to 112. The next shakeout could be the truly big one. 25 to 35% down to the 80 to 90 range. Make absolutely sure you can survive that psychologically and financially without panic selling. Make sure you have cash ready to buy it when we hands capitulate. Don't let the recent recovery fool you into over-leveraging now. To the aggressive bulls, you bought the 102 dip. Maybe you're using leverage right now. You're convinced 150 to 200 is coming, and you want maximum possible exposure to capture it. You might be completely right about the destination, but please deleverage before the next shakeout hits. The January 27th crash proved beyond any doubt that leverage kills even correct positions. Own physical metal, raise cash, give yourself the ability to survive a test of 85 to 90 without liquidation. Being right about the direction doesn't matter if you're gone before the move actually happens. The silver market just did exactly what I've been warning about for months. 2 violent shakeouts within a continuing bull market. January 8th crashed to 76. January 27th crashed to 102. Leveraged bulls destroyed, despite being directionally correct about $100 plus silver. And it's not over, not even close. The final massive shakeout, the 25 to 35% one that takes silver from whatever new high it makes down to $80 to $90, is still coming. It will probably be the final washout before the real parabolic move to 150 to 200 plus. The bulls who understand this will be prepared. They'll hold physical metal through the insane volatility. They'll buy the panic with cash reserves they kept ready. They'll be properly positioned when silver breaks out for real and never looks back. The bulls who don't understand this will be shaken out. They'll sell at 85 to 90 in absolute terror. They'll watch helplessly from the sidelines as silver does exactly what they predicted without them in the trade. The path to 150 to 200 goes through 80 to 90 first. The path to generational wealth goes through gut-wrenching drawdowns that test your conviction. The path to being proven right goes through periods of feeling completely, utterly wrong. Don't be the person who was right about silver and still lost money because you couldn't survive the journey to get there. You now have the information, you have the proof from what just happened in January. You have the warning about what's coming next. What you do with all of this is entirely up to you. Make the right choice.